Hi everyone, I'm Leah with Sense Financial and welcome to our live Q&A session. It's really great to see everyone today, and for this webinar I'm here with our speaker Brett who will be answering your questions. We do have some pre-submitted questions with us here that you had to send in for today. And of course, if you have any questions right now or at any point of the Q&A, you can go ahead and type them up in the chat box that you can find on the right-hand side of your screen. Before we begin, my name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I briefly want to introduce Brad, our speaker for today, and he is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing, but is also a licensed California real estate agent and has passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. So thank you so much, Brad, for joining us for today. And let me know if you have anything to add before we start our questions.
All right. Yes. Thank you, Leah. Appreciate you being here as well and for the kind introduction. Looking forward to answering some questions here. If you're out there in the social media world, I don't know. Leah can tell you how to send a question in to us, but would love to answer your questions as well. And we do have some pre-submitted ones that we'll go through, but we want to encourage people to submit questions live here on the call as well. But yeah, looking forward to answering some of these and providing some value here.
All right, we'll get started with the first questions that we have for today. This is from Jay. He asks, how do you catch up on loan repayments?
How do you catch up on loan repayments? Well, Jay, if if you get behind, your loan paperwork should indicate what the late fee is. If you get so far behind, and I don't have the actual loan paperwork in front of me, but if you get so far behind at a certain point, the loan is just going to have to be considered a distribution, which is going to be a taxable and penalty event if you're under 59 and a half. And so you want to stay up to date on your loans. Of course, they can be made quarterly or monthly. It depends on how you set up the initial loan paperwork. And we do have more information in our client portal. Not sure if you're a client or not, Jay. If you are, then you have access to our client portal to see more information on how the participant loan works, as well as the documentation needed to take an actual loan. But you're welcome to reach out to us if you want to talk one-on-one as well. Good
Thank
question.
you for that, Brad. The next question is from Race. He asked, can we invest part of our solo 401k Roth money into Bitcoins?
Can you invest solo 401k Roth money into Bitcoin? Sure, absolutely, yeah. Roth traditional, either way, it all works. You're going to need to go through one of the exchanges like Gemini or Kraken or one of those, and just make sure that the account at that exchange is opened up in the name and tax ID number of the plan, or of the plan, because you said solo 401k, and make the investment. Just like any other investment, it's just done in the name and tax ID number of the solo 401k, and you can keep the crypto inside the exchange, or you can utilize a cold storage method, which is going to require you to only use that cold storage device for the solo 401k and for nothing else. Otherwise, it could be a prohibited transaction for commingling. So you want to stay away from that. But it's pretty straightforward otherwise. So hopefully that answers the question.
The next question is from Rohit. He asks, how to invest jointly with my wife's 401k and my non-401k funds?
Hey, Rohit, thank you for the question. So, how can I invest with my wife's planned funds as well as my personal funds? Well, two different questions here. Um, and part of it kind of depends on the actual investment that you're making as far as the logistics are concerned. But let's just assume for a second it's a piece of real estate. You and your wife can both be on title to the real estate. Now, if we're talking about your solo 401k plan, the plan owner excuse me, the investor is the plan. So even if you and your spouse are both participating in the same solo 401k plan, there's only one plan. It's let's just call it Rohit Solo 401k plan. So that's what's going to go on title for the investment. Where the funds come from within the plan is up to you, up to the plan owners. In this case, you and your spouse. So let's say you want to put in 50,000 and your spouse wants to put in 50,000, then that's $100,000 total, 50-50. The plan, Rohit Solo 401k, is the sole owner of the real estate. But underneath that, each plan participant is participating in the initial investment in 50% and all the returns, all the rental income, the appreciation, the net gain, everything else when it sells, and then also any expenses related to that investment have to be shared all at the same pro rata percentage that the initial investment was made in this case 50-50. And so the simple way to do this within a solo 401k plan is to have three checking accounts. Okay, so at the bank you will have the main relationship is the solo 401k plan, but you can have as many checking accounts underneath that opened up as you would like. So you would have one for you, and you can give it a nickname like Rohit Traditional Contributions as an example, and then your wife can have another one for herself. You can give it a nickname, Wife Rollover, Traditional Rollover, whatever it is. And then you can open a third checking account called an operating account. And I recommend naming this operating account, giving it a nickname that is relevant to the investment. So if the property address is 123 Main Street, then I would nickname this operating account 123 Main Street. And then when you get ready to make the investment, you can transfer 50% of the funds needed from your wife's account, 50% of the funds needed from your account into this operating account. And that way you're doing the initial down payment, closing costs, home inspection, and everything is coming from one account instead of two. It's all coming from the solo 401k plan, but it's coming from one account representing 50% your money, 50% your spouse's money, and then all the returns can come back into that checking account as well, that third operating account. And then once a quarter or so, once a year at minimum, you're going to want to rebalance everything out, right? So if it's 50-50 and the balance inside this operating account is $20,000 at the end of a quarter or a year or whatever time frame you want to do this, then I recommend you transfer $10,000 to your account and $10,000 back to your wife's account just to rebalance everything out. Now, you don't necessarily want to bring that operating account to zero because there's going to be some ongoing expenses, most likely with my example of a rental property. And so you want to keep something in there so you don't have to be transferring money back and forth all the time. But whatever it is, 50% here, 50% there. So that's how I recommend doing that within a solo 401k. Now, on the other hand, if the second part of your question was how do I invest with my plan, right? So I presume you mean your own personal money investing with your plan. While this is possible, it adds complication and the increased risk for a prohibited transaction by accidentally commingling funds. Also, a plan owner cannot enable their plan to make an investment. The plan must be able to make the investment without your or any other disqualified party's funds being added into the mix. So for these reasons, we highly recommend you just keep your personal money separate from your investment money. And just don't mix it up. It's just adding complication and unnecessary risk, like I mentioned. So good questions.
All right. The next question is from John. He asks, what is the best way for a Roth Solo 401k to avoid UBIT?
Well, John, first of all, a solo 401k is exempt from UBIT tax, unrelated business income tax, on leveraged real estate. Okay. An IRA is not. Both plans and for that matter, yeah, both plans and any self-directed account, whether it's an HSA or a SEP IRA or a traditional or Roth IRA or a solo 401k, all of those are subject to unrelated business income tax if the plan is conducting active business. So an example of active business is flipping a bunch of real estate, right? That's not a passive activity. Retirement accounts are designed to be, and even in HSA, they're designed to be invested passively, not actively. And so when they get into this active business realm, the IRS says you can do it, but we're going to level the playing field between your retirement account in a tax advantaged environment. We're going to level the playing field between you doing it in there versus Mr. and Mrs. Smith running a business personally. Let's use the example of a dry cleaners. If Mr. and Mrs. Smith own a dry cleaners, they're paying all the taxes that they have on earned income. It's an active business. Inside your retirement account, you might try and get away with having to pay that tax by doing it inside your retirement account, but the IRS says, no, sorry, you can't do that. So you're going to pay the same, your retirement plan is going to pay the same tax that Mr. and Mrs. Smith are paying on that income. Now, this is all factored after accounting for losses and even in the case of leveraged real estate and an IRA, depreciation on the same portion that correlates with the leverage. But I'm mixing up a little bit of the conversation on UBIT with leveraged real estate in an IRA versus UBIT for an active business. They are two separate conversations, but the calculations work the same. Okay, so hopefully that answers your question. I can clarify more if needed, and we do have separate training on the subject of UBIT and UDFI tax if someone wants to learn more about that.
Victor asked, do you prepare self-directed HSA with checkbook control?
Victor, good question. We do not at this time. However, we will be providing HSA shortly and self-directed HSA. And let me tangent a little bit on this because I think it's an amazing product. Okay. So let me say this first. If I understand correctly, and I think I do because I have it from pretty reliable sources, starting January 1st of 2026, all health insurance plans will be HSA eligible. Until now, it's been only high deductible plans, which not everybody wants because people want to not have a bunch of out of pocket. They want to have low deductibles for obvious reason. Well, if the information I have is correct, which again, I'm almost certain it is, on January 1st, anybody can have an HSA, which is going to be huge because the HSA is probably in a lot of cases better than a Roth. Actually, it is. First of all, it's tax deductible contributions. It's tax-free growth and it's tax-free distributions. And to add a fourth, people call it the trifecta, but it actually has a fourth item, which I call the kicker, an added bonus, which is that you can take the distributions before you turn 59 and a half, before you retire. IRAs, 401ks, you can't take the money out until you're 59 and a half without taxes and penalties. Roth has a little bit of a different story there, but the HSA has all of that before you retire. And so if you are able to pay for some of these medical expenses that you would normally pay for with an HSA, if you're able to make these medical expenses with personal funds now and let the HSA money grow and be invested and stay invested, keep the receipts for these eligible payments, and then you can quote unquote cash in these receipts anytime. Next year, 6 months from now, 20 years from now, and you can build up these receipts. I could have 20 years from now, I could have $10,000 or more of receipts, and I can cash that in for $10,000 out of my HSA without any tax implication. And it's around $16,000 of annual contributions for married filing jointly. And so it's even more than a Roth IRA. It's actually over 16,000. And a Roth, of course, if you're under 50, 7,000 per person per year. So that's 14. If you're over 50, that's 8,000, which is 16 but the HSA is a little bit more than 16. So for a lot of reasons, I think the HSA is even better. And yes, we will be providing self-directed HSAs very soon that you can use to invest in alternative assets, and just like you can with our checkbook IRA and solo 401k. So very excited about that. Can't wait to offer that. So thanks for the question.
We also have a question here from our live stream chat. It's from Giselle. She's asking, can I contribute to my employer 401k, my solo 401k, and also to my IRA?
Giselle, great question. Thank you so much. Yes, you can actually. Um, the only thing you cannot, first of all, IRA and 401k are totally separate from each other. You can always contribute to both of those. Okay. So, as I mentioned a few minutes ago, the IRA contribution per year, both Roth and traditional, not doubled up, but total is $7,000 if you're under 50 per person. Okay. For a 401k, it's $23,500 if you're under 50. So you can't double up on that number. If you're maxing out your employer sponsored 401k plan at 23,500, you can't also make 23,500 as an employee contribution into the solo 401k. And let me back up a little bit. A solo 401k has two ways you can make contributions. Okay. One is as an employee and one is as an employer, because you have to be self-employed to have a solo 401k. The IRS says, okay, you're not only the employee working in your business, but you're also the employer. You are the business owner. And so, depending on how your business is structured, will dictate how the contributions are made. But you can always make up to 23,500 as an employee contribution per person, not per plan. And on the solo 401k, you can make this roughly 20% of the profit or 25% of the payroll if you're W-2, like an S corp filing, in profit sharing contributions. So the maximum for the solo 401k is 70,000. How you get there is dependent upon somebody's situation. It could be a combination of employee contribution up to 23.5 and profit sharing, or it could be all profit sharing. So it really depends on how much you're contributing to the employer sponsored 401k plan. Will dictate how much you can contribute as an employee to your solo 401k, but the max is always 70 in the solo 401k. So hopefully that makes sense. And thank you for the question.
The next question is from Ned. He asks, can I transfer my existing Schwab IRA brokerage account to my 401k?
If it's a traditional account and not a Roth account, then yes, you can. Roth IRA is the only type of, well, there's one other exception, but Roth IRA cannot move into a 401k, cannot roll into a 401k, whether it's a solo 401k or an employer sponsored plan that you have with your employer or whatever. Roth IRA just can't. But traditional IRA can roll into your solo 401k. That is not a problem.
And Leo asks, what are the rules for converting solo 1k into Roth?
What are the rules for it? Well, I'm not sure I'd pose the question by asking about rules, because it's allowed. It's really just up to you. And the Roth conversion is a very powerful way to get more money in Roth, because typically a lot of people have existing traditional funds, and quite a bit of them, if they have been investing into their retirement plan for any number of years. Most of us are looking at the here and now, and we are eager to reduce our tax liability today. And we're not necessarily thinking about our future beyond that. And so we opt for traditional contributions. When the IRA, traditional IRA concept was introduced by law in 1974, the idea was, let's allow people to make these traditional contributions and give them a reward, so to speak, by reducing their tax liability today. So if you make a $7,000 traditional IRA contribution, or $20,000 401k contribution, whatever, which wasn't around in 1974, you're reducing your earned income by that amount for this year. Now it's growing tax deferred, and the taxes are paid. You're essentially partnering up with the IRS in this situation, and probably your state government as well. But the taxes are paid upon distribution, right? When it's Roth, you are paying the taxes on the contributions today, but not at retirement. So if you have more money in Roth, your future self will thank you for incurring the taxes earlier, so that your retired self rather can have tax-free ATM withdrawals. Also, it can be your heirs can inherit Roth accounts, 401k, IRA, and have no taxes. Okay, so the Roth is a beautiful thing. Again, I just wanted to explain the difference between the two. But rules, I mean, the rule is that you can convert from traditional to Roth. Whether you do it or not is up to you. Making an informed decision is going to partially depend upon your conversation with your CPA or tax advisor. What is my earned income this year? And what is my tax rate this year? And how much more earned income can I add to my situation before I tick myself up to the next highest tax bracket? You might not want to go from 22% to 24%, but you might have $10,000 more of room to stay at the 22%. So if you have 10,000 of traditional funds, you might want to consider converting that $10,000 to Roth, which again is going to be taxable income, but now it's tax-free forever after that. So it's completely up to you. Hopefully that makes sense. We can talk further about Roth conversions because the example I gave of converting cash is only one way to do it. But yeah, you could certainly do it. It's just dependent upon whether you want to or not.
Philip also asks, what are the investment options for solo 401k and self-directed IRA?
Solo 401k and IRA can invest in anything except for collectibles. Life insurance in an IRA is not allowed. And you need to be aware of who the disqualified parties are that would trigger prohibited transactions if they were part of an investment. And the disqualified parties are you and your immediate family. Okay, you and your spouse, your children, their spouses, your parents and your grandparents, the lineal descents, and your wife. And so what that means, here's the question to ask. Am I or any of the disqualified parties to my plan going to directly or indirectly benefit from something the retirement account invests into? This can be a monetary benefit or it can be a non-monetary benefit. For example, none of those disqualified people can go spend the night at one of the rental properties that is owned by my retirement account. None of those disqualified people can go swing a hammer at the house that the retirement account owns. Okay. How are you directly benefiting from swinging the hammer? Well, you could argue you're not, but the IRS says you cannot provide services. And the easiest way to delineate what is a service that I might provide to my IRA or 401k versus what's not a service is this. White collar, okay, blue collar, bad. That's the easiest way to think about it. Okay, so hopefully that helps.
We have a question from Tiffany. She asks, what are the steps for taking a personal loan from your solo 401k?
Well, assuming you're a client of Sense Financial, log into the client portal, go to maintenance, and then go to participant loan. It's a drop-down menu. Click on participant loan, and you will see line-by-line instructions about how to put a loan together. Essentially, you can borrow up to 50% of the plan value, total plan assets, or 50,000, whichever is less. Okay, you can't go over 50,000, and you can't borrow more than 50% or 50,000 in any given 12-month period. So it's a rolling 12 months. So for example, if you had a $50,000 loan and you paid down 10,000 today, on October 20th of 2026, you could borrow another $10,000. It's based on whatever the highest balance is over the last rolling 12 months. Okay. And again, like I said earlier, those can be paid back monthly. That can be paid back monthly or quarterly. The interest rate is prime plus 1%, and there's no prepayment penalty, and you don't owe any interest on, um, if you pay it off early, you don't owe interest on the principal that you paid off early. Okay. So that's how it works.
The next question is from Wayne. He asks, how much can you contribute to your solo 401k for 2024?
Well, Wayne, if you're under 50, $70,000, and if you're over 50, $77,500. And that's a combination usually of employee contribution and profit sharing. It just depends on your situation, how much of each that you will make.
Tanya asks, how do I roll over an employer-sponsored retirement to my solo 401k? I left the job, but not out of retirement.
You left the job, but not out of retirement. I'm not sure what that last part means, but if you have a former employer plan, 403b, TSP, 401k, I'm probably forgetting one of them right now, but they can all be rolled into another type of account. Usually people roll over into an IRA. And usually they roll over into an IRA that's going to only invest in the stock market, like at Vanguard or Fidelity or Schwab. Obviously, what we do is in the self-directed environment, you can roll it over to an IRA that we create here at Sense Financial, and then you can self-direct that into alternative assets. So you would work with us first in creating the account, getting started, and then you will work with both custodians. The receiving custodian, which is the new self-directed custodian, would be the one to send over the transfer request, the rollover request to your current provider, and then they will wire those funds into the IRA. If it's a solo 401k, same beginning part, work with us, get started in the process, we'll create the plan, and then you as the plan administrator, because there is no custodian, you as the plan administrator and the trustee of the plan will then turn around and send that transfer request or direct rollover request to the current provider so that they can send you a check that you will then deposit into the checking account for the solo 401k. And plan on 1 to 2 weeks for any rollovers, okay? Whether it's to an IRA or 401k.
Craig asks, what is the difference between your IRA trust and IRA LLC?
Well, Craig, the IRA LLC has, besides the simple answer, which one is a trust and one is an LLC, let me highlight some differences, okay? An LLC has to be filed with the state. A trust does not. They're both special purpose. They both have language inside of them that indicate what it's for, primarily to give the owner of the IRA checkbook control. The prohibited transactions and disqualified parties are listed out. It has to be IRS compliant with special language. And the LLC is going to have whatever annual filing requirements the state that it's filed in has or requires, right? So if you're in California, or whether you're in California or not, if you have a California LLC, the annual tax is $800. Okay, we can avoid that by filing the LLC in a state like Arizona, which is $0 per year. Or we can do an IRA trust, which avoids that altogether. Some people like the limited liability protection that an LLC provides. We're not asset protection attorneys, so talk to yours for more information on that. Part of it depends on what you're going to do with the plan, right? There's a difference between owning a rental property and just being a passive investor in private loans, right? One has a little more liability than the other, of course. And so it's up to you. The IRA LLC has been around since 1996. It's very tried and true. It's been challenged by the IRS as a um, invalid setup, as a prohibited transaction because it involves a disqualified party, the IRA owner, controlling the funds without going through a custodian, aka checkbook control, and it's held up. Okay, there's case law, there's opinion letters from the IRS, there's all kinds of stuff that reinforces it as a valid setup. Um, the IRA trust has not had the same level of scrutiny. Okay, so if you ask me which one you should do, most of the time we're going to say IRA LLC for all the reasons I just mentioned. Again, everybody's case is different, and we're happy to have a conversation. But those are the primary differences between the LLC and the trust. It's still owned by an IRA. You're the manager of the LLC, which holds all the funds and the assets, or you're the trustee of the trust, which holds all the funds and the assets. And you still have the same type of checkbook control. One is just a trust, and one is just an LLC. So those are the primary differences.
The next question is from Nick. He asks, I am paying off my Soul 1K loan this month. Is there any paperwork that I need to file or complete?
Just no. Thank you for the question, though. You're paying off your Solo 401k loan. Um, that's got to feel good, by the way, getting that off the books. No, just keep your records. I personally, for all transactions, keep a spreadsheet, just a simple spreadsheet on Google Drive or Excel or whatever, and just keep track of the transactions. Okay, if there's a participant loan, I would have another tab on that same spreadsheet that is titled participant loan, and I would have the outstanding balance. And every time I make a payment, I would indicate what the dollar amount was and what the remaining balance is. And then eventually you're going to get to zero, and just keep that on file. But no, there's no paperwork to file with anybody. Remember, with the solo 401k, you are the plan administrator. There is no custodian. So you are the fiduciary of the plan, and you are with the IRA as well, but that's a little bit of a different conversation. Not only are you the fiduciary of the plan with the 401k, but you actually have the power and the control and are required to actually do everything related to not only investing the 401k money, managing the investments, but also managing the plan, administering the plan itself. That includes contributions, distributions, Roth conversions, um, participant loans, etc. So keep everything on file. 99.9% of this never has to be furnished to the IRS unless there's some kind of audit situation, which is really rare. So you want to have the records in case. So, and then with the IRA, you are the fiduciary, which means for both plans, actually, the IRA and the 401k, your responsibility is to grow the plan wisely, aggressively, as wisely and aggressively as you can, and also keep track of everything from a bookkeeping perspective. So bear that in mind as well. But with the IRA, there's a custodian. The custodian is there by law, and you have to go through them for contributions. You have to go through them for Roth conversions, distributions, and the annual valuation. None of that exists as far as the custodian is concerned for the 401k. So good question. Thank you.
Next, we have a question from Sarah. She asks, can I open a solo 1K if I have a W-2 job as well?
Yes, you can. And we touched on this a little bit earlier with Giselle's question, but yes, you can have a solo 401k and you can have a 401k at work. I mean, technically, there's no max to the amount of 401k plans you have. The max is the 23,500 of employee contribution per year. There is a $7,500 catch up annually if you're over 50. So that's $31,000 if you're over 50. But that's the max, not the amount of plans that you can have.
Jeffrey asks, can my spouse participate too? It doesn't state for what, but I believe this is regarding the solo 1K.
Yes, you can, or yes, the spouse can. Um, so let me just say something real quick about retirement plans. All retirement plans are individual, okay? There's no such thing as a quote unquote joint retirement plan. Now, the closest thing to it is the solo 401k because both spouses in the right circumstances can participate in the same plan. But much like if you both worked at Walmart and you participated in Walmart's 401k plan, it's the same plan, but you each have your separate accounts underneath that plan. It's identical with the solo 401k. There's just no Walmart and there's no custodian, but it's the same concept. And so the short answer is yes. Whether the wife does or can or it makes sense is kind of a per case by case basis situation. But typically, if both spouses are self-employed or one is self-employed and employs the other, or they have some kind of partnership or joint venture that qualifies for self-employment activity, you just can't have any full-time W-2 employees outside of the business owners and their spouses, then yeah, both spouses can participate. So yeah. And by the way, the benefits double. So the contribution amounts double, not 70 per year. It's 140 because it's 70 per person, right? The participant loan option, same thing. It doubles, or it's 50% or 50,000, right, per person per plan. So, yeah.
Reed asks, how do Roth conversions work in the solo 401k?
Oh, I love this question. So we touched on Roth conversions a little bit, but let's talk further about it. So, um, an IRA is either Roth or traditional, but it's not both. So you can have both as self-directed plans. That's fine, but it's two completely separate plans. With a solo 401k, there's a Roth component and a traditional component built into the same plan. So both types of funds can be housed under that 401k. And because of that, if you want to convert, it's easier in a solo 401k because the money doesn't ever have to leave the plan. It just moves buckets. It moves from the traditional bucket to a Roth bucket. And furthermore, I talked through briefly earlier about how to about the concept of converting cash in a plan, but there's actually another way to do it. You can convert assets in the plan. It's called an in-kind Roth conversion. In kind means that it stays as the same kind in the same plan, right? So let's use a multifamily real estate syndication investment. So if you have, and we've had clients do this. In fact, I'll give a real life situation. Had a client with his solo 401k invest in a strip mall. The total investment was like $3.3 million. Okay. He rolled in IRA money to his 401k, his solo 401k that we created, made a $300,000 investment into this strip mall. His 401k is a limited partner in the LLC that actually owns the entire $3.2 million project. Okay. It's a triple net lease, which just means that the tenants are paying all the maintenance, common area maintenance called CAM for short, and the property taxes, et cetera. The tenants pay for all that stuff, which is pretty cool. Now, what he did is he took this investment to a valuation company, Equity Valuation Associates, actually, and them and I think two or three others are on our website under vendors if you want to check them out. And he took this investment. He said, hey, valuation company, I need an appraisal for this investment for the purposes of doing a Roth conversion. So he sent everything they required to them. And then he got a 23-page appraisal report back. And the fair market value, or FMV for short, came in at $200,000, which means he got a 33% discount on his Roth conversion. He converted the entire $300,000 investment and all the future gains and payments and everything that come in from that investment to Roth, but only added $200,000 to his taxable income. So he got a 33% discount on the Roth conversion. So that's an example of how you can convert an asset and real life numbers inside of a solo 401k. And the beauty of it is that you don't have, first of all, you don't have to work with a custodian, because with the solo 401k, you are the plan administrator. So you have the power to do all of this. And the other part of it is it doesn't actually have to change title. It's not moving from one plan to another. It's all still in the solo 401k. It's just Roth now instead of what it was, which was traditional. So he just changed his and his heirs, most likely, financial future forever, because he's a pretty young guy. I can't remember how old he is, but I think he's under 50. And so he's got a lot of years left to invest. I mean, this could potentially be worth millions of dollars by the time he turns 59 and a half, which is going to be all tax-free ATM withdrawals. In fact, he could even distribute the property to himself at retirement completely tax-free. He literally just has to go through a title change from the 401k to his personal name or personal LLC or whatever he decides to do. And he can own that property and then start getting payments to himself. Now, once he owns that property, the payments are going to be taxable because he owns it now, not the Roth. But there's no tax implication on distributing the Roth cash or assets to yourself as long as you've had it for at least 5 years. And one more note on that. Each Roth conversion has its own 5-year clock. Okay. So I don't want to go down that rabbit hole right now, but each tax conversion has its own 5-year clock. If I convert money today, the 5-year clock starts on January 1st of 2025. It reverts back to January 1st. So on January 1st of 2030 is when I've had that Roth conversion, those Roth funds for 5 years, which means I can distribute it to myself without taxes or penalties as long as I'm over 59 and a half. If I'm under 59 and a half, I can only distribute the principal amount that I converted to myself without taxes or penalties. And, I probably wouldn't do that, right? So.
The next question is from Nora. What happens if I hire employees in the future?
Ah, well, Nora, it depends on how many hours they work. First of all, if you have a solo 401k, I assume that's where the question is coming from. The only way that you can validly have a solo 401k or legitimately qualify for one is if you don't have full-time employees. And full-time is defined as basically 500 hours, starting 2025, 500 hours a year. 500 or more hours per year for a W-2 employee will disqualify you from having a solo 401k. Now it needs to be a group plan. That's not a solo 401k. That's a regular 401k. And there's no self-directed on that. You're going to be in Wall Street. And so if that happens, we should talk. You can roll the funds and the assets to a self-directed IRA if you want to continue investing in alternative assets, or you should, or you can just roll the money into a traditional IRA or your new 401k if you don't want those alternative assets anymore. So, yeah.
Caleb is asking, can I partner my IRA or 401k with personal funds or with another investor?
Oh, yeah, we talked about the personal funds aspect a little bit, but definitely you can do it with another investor. Absolutely. Hold on, I'm gonna sneeze. Sorry, bear with me. Okay, it passed. False alarm. Um, so yeah, I mean, of course, you can participate with other investors. In fact, you know, something that a lot of people do is they invest with other people, right? Maybe you only have $20,000 in your IRA and you want to do private lending. Well, you can invest with somebody else that has more money or whatever you need to make that investment work. I would say, um, you know, don't do it in most cases with a disqualified party, but as long as the investor can do kind of a fractionalized situation on the loan and have it be completely separate from each other, you know, it might be okay. But I'd want to kind of dissect that on a case by case basis. But better if it's third party. But yeah, you can absolutely do that with yourself. Again, just caution. Probably don't recommend you do that with either you or a disqualified party. Okay, to keep it simple.
Same as what happens if I already have an SEP or simple IRA?
Um, yeah. So with a simple or a SEP, I mean, typically, first of all, you can have 401ks and IRAs together. You can't double dip on the profit sharing contributions on a SEP IRA and a solo 401k. So if you have one business and you qualify for solo 401k, then the solo 401k is the way to go because you get you get to the max faster, right? It has employee and profit sharing built into it. Whereas a SEP IRA has only the profit sharing, right? And so they have the same maximums of 70,000, but you get there a lot faster with the solo 401k. So there's no reason to have both because I can't contribute to both. I can't max out both. And so, plus one's an IRA, one's a 401k, and then just the 401k is easier because you don't have to deal with a custodian. But but yeah, you probably don't have both. So hopefully that helps. If you have separate businesses or the time of year, because you're already past the cutoff to be able to do the solo 401k for prior year contributions, sometimes a SEP can make sense to set up, and then you can convert that to a solo 401k almost immediately. So there's some strategy involved there, depending on what's going on. But typically, you don't have both.
Nikki asks, how does Sense Financial support me with compliance?
Yeah, good question. Well, if you, it depends on what kind of compliance you're talking about, but typically, you as the plan, if it's a 401k, you as the plan administrator are responsible for the compliance. Okay, that's literally your role. Now, at Sense Financial, we are the plan document provider. We provide the plan, and you essentially lease the plan from us. And so, related to the plan and our role as a document sponsor, we are doing our own annual filing requirements with the IRS, essentially saying that your plan is still active and valid and in good standing. But as far as the valuation or any reporting any sort of taxable events like a Roth conversion or a 1099 that needs to be issued, you're responsible for that as the plan administrator. We give you all the tools you need to administer the plan in our client portal, and we're happy to answer questions, but we don't do all this stuff for you. If you want to send us something that you fill out, like the 5,500 valuation or even the participant loan document or whatever, like send it to us and we'll take a look at it and we'll validate that you filled it out correctly. But you have to be the one to do that and work with your tax advisor accordingly. And then for the IRA, there's a custodian, right? Our role is setting up the LLC and the and or the trust to give you the checkbook control. The custodian is a third party company. We work directly with them as a partnership, but they are there for all the tax reporting requirements and everything else that's involved. So a little different depending on which plan you have.
Rafa asks, can my solo 401k invest in an LLC?
Yes, actually, it can. The Roth conversion example I gave is exactly what happened, right? The solo 401k of our client was invested as a limited partner into an LLC. And so, yeah, definitely. You wouldn't want to be a general partner in that situation because the general partner has um, more responsibility that they are doing on the commercial property itself. And I mean, theoretically, it could be the owner. The 401k could be the owner of an LLC that owns property, but there's no you don't have to have that LLC in place unless for some reason you wanted the asset protection or something like that.
And now we're approaching our final question for today
All right.
from Silas. Can you help with tax filings or CPA coordination?
Oh, yeah. Good question, Silas. I think we covered that a little bit already. We do not do tax filings. We're not CPAs or tax preparers. However, if you get stuck on something, again, we offer unlimited client support. So feel free to contact us if we can help you with anything, or if your CPA is like stuck on something or whatever. we're happy to get involved and help however we can, but we do not do tax filings directly for people. So, all right.
All
Anything else?
right. And that would be all of the questions that we have for today. But thank you so much for everyone who had submitted these questions. It
Yes.
is really great to hear from all of you, and we're excited to help you through our Q&A sessions. Brett, anything that you'd like to add before we wrap this up?
Yeah, if you're on here and you are not a client of Sense Financial, I highly recommend you continue educating yourself on the self-directing of retirement. It is for a lot of people, it's a brand new concept they've never heard of, and maybe you're that person. Go to SenseFinancial.com, like common sense, by the way, not dollars and cents. SenseFinancial.com, and just click through the different drop-down menus. There's two primarily for the solo 401k and the checkbook IRA, and just click on the different options and educate yourself. From a philosophical standpoint, here's how to think about it. I can put my money in the S&P 500, and whatever happens, happens. I know I can look back on the history and I can see what it's done over the course of the last, 20 years or 50 years or whatever. Pretty good indication of how it's going to perform moving forward. Sure. No guarantee, obviously. However, when I self-direct, I get to choose the investment. I get to choose the property or the people I loan to, my 401k loans to, rather, my IRA loans to. People are signing on the dotted line in a lot of cases as to what the terms and the payments and the returns are going to be. Is it guaranteed? No, sure. Somebody could stop paying. But it's as close to a guarantee as you're going to get, because you're not signing on the dotted line with the S&P 500 or Elon with Tesla, guaranteeing a certain return on your investment. Okay, like you can with alternative asset investing. And the beauty of it is that you get to invest in what you know and what you understand, therefore what you have more control over, which should be a safer investment for your plan. And so you can get real good returns on your money inside of a self-directed account that you just can't get for all the reasons I mentioned inside of the stock market. Not a bad idea to have both, by the way. I'm an advocate of both, but they have their place, and diversification is important. And the only way to truly diversify is to have a self-directed account. So that's it. I'm off my soapbox. Thank you.
All right. Thank you again so much to everyone who had watched our live stream today. And thank you for Brad for helping answer these questions. We'll be wrapping up, and that's all for today.
All right. Thank you, everybody. Thank you, Leah.